Assalamualaikum warahmatullahi wabarakatuh. Selamat pagi dan salam sejahtera. Yang berbahagia Datuk Ahmad Hizat Baharudin, Director General Labuan Financial Services Authority, Datuk Azlan Hashim, Chairman of Labuan IBFC, Saudara Raymond Wong, Chairman Labuan International Insurance Association, esteemed speakers, tuan-tuan dan puan-puan yang saya hormati sekalian. Thank you for the opportunity to speak here at the Asian Captive Conference 2017. It is probably fair to say that captives have had, at least at best, an uneasy relationship with regulators. Captive insurance did not get off on the right foot with regulators. In the early days of the modern captive, efforts to regulate captives were mostly ill-suited to the nature of the captive business. Prudential and market conduct regulation intended for the protection of the general public were applied equally to traditional and captive insurance. This chipped away at the cost savings that captives were set up to achieve. In response, captives relocated and domicile in jurisdiction with less onerous regulation, which with the benefit of hindsight, not a very good start. Fast forward half a century, captives have an entrenched reputation for being tax evasion vehicles of large corporations. Offshore centers that are host to many captives have come under greater scrutiny with stronger tax and regulatory regimes back on the cards for captives. We seem to have come full circle and possibly still without a clear grasp of how captives, as well as the economics in which they operate, have fundamentally changed over time. This raises a risk that the captive and regulatory community may yet find itself caught wrong-footed again, with potentially higher stakes at hand. I thought that it's worth talking about the role of captives in the shifting sense of business in the 21st century. I would like to share some thoughts on what the future holds for captives as we contemplate the changes taking place around us. Major risk events often strike without prejudice. Typhoons do not discriminate in the havoc that they wreak. Terrorist attacks affect innocent bystanders who happen to be at the wrong place at the wrong time. Organizations across the globe, no matter what their purpose, have been targeted by cyber attacks, from the National Health Service in the UK, to schools in China, to chocolate factories in Australia. Organizations large and small, for-profit or non-profit, have borne the brunt of ransomware attacks. Thanks to globalization and advancement in technology, the impact on businesses is also more far-reaching and larger in scale than ever before. The malware WannaCry hit 200,000 computers in 150 countries. Attacks on multinational transport companies based in Europe stranded cargo at ports in India. The losses from these events are large. Cyber theft cost the global economy more than $450 billion in 2016. Lloyd's of London estimate that a global-scale cyber attack could rack up losses of $53 billion, similar to a catastrophic natural disaster such as the US Superstorm Sandy in 2012. Unsurprisingly, risk awareness is now growing across the entire spectrum of businesses. The 2017 Alliance Risk Barometer, which covers mainly large corporates, as well as 2016 Zurich study on SMEs, revealed that cyber risk is topmost on businesses' minds. The same study showed that in Asia Pacific, there are now twice as many SMEs that worry about cybercrime, fire, technological vulnerabilities, health and safety of customers or employees, and corruption compared to 4 years ago. Yet, in terms of preparedness for dealing with risk events, there is a marked disparity between large corporates and mid-sized and smaller companies. Predictably, larger companies are the ones that tend to have a structured risk mechanism, as well as the resources and expertise to deploy risk management tools. Larger companies also tend to have better access to specialist insurance products and the resources to establish a captive. Indeed, 90% of Fortune 1000 companies have a captive insurance company. Ladies and gentlemen, smaller and mid-sized companies are a different story. Most do not consider captive as a feasible risk management option. However, this is changing with innovation in captive models, such as group and rental captives and protected sale companies. It is not only possible for smaller companies to engage captive. A more compelling business case is emerging for the use of captive as small as mid-sized businesses evolve. Some of the most significant small business trends in 21st century include disaggregated business network, shorter cycles of proprietary knowledge, and rising entrepreneurship powered by the younger digital generation. Take, for example, high-growth tech startups. As disruptors, their business models and risk profile are often unique. Much of their competitive edge is derived from concepts and technology that are new to the market. Ride-sharing platforms such as Uber and Grab are built on seamless apps that work exactly the same whether in London, New York, or Kuala Lumpur. From an insurance perspective, however, trans-border solutions for such businesses are substantially more complicated. The ride-sharing model combines private vehicles with commercial use. The seamless insurance coverage for Uber drivers that integrates exposure from private and commercial use and satisfies the mandatory requirement under different domestic laws are not yet fully developed in all markets. This example calls for bespoke and efficient solutions which may not be readily available in certain traditional insurance markets. To put this in perspective, Google has projected that Southeast Asia's web-generated business will multiply over 6 times to $200 billion by 2025 and $31 billion in 2015. The massive impact of technology on the world as we know it will create new insurance gaps and demand for bespoke solution. This will set the stage for captive to take on a more active role in risk management ecosystem. Companies that are altering the business landscape will need creative and efficient risk transfer solutions that address their unique business needs. Used alongside other risk management strategies, including the traditional insurance market, captives now allow companies to design an optimal risk transfer structure. For example, most standard risks can be insured in the traditional market, while more specific and bespoke risks can be tailored and underwritten by captive. The benefits go both ways. Captives can and should also contribute significantly to the development of the industries they serve. Insuring with captive enables businesses and economies to better weather insurance market cycles, especially for smaller and mid-sized companies. Captive can be a powerful catalyst for more mature risk management practices and culture. This comes from putting control of a company's insurance needs in its own hand and encouraging a longer-term and more sophisticated view of risk. The effects are also accrue to the wider insurance industry. The captive can act as a risk incubator by recording and accumulating data and information about lesser-known risks. In time, this will promote conditions for the development of new products and services. Markets, as business and solution providers, continuously seek out more efficient ways to manage risk. Ladies and gentlemen, what the future holds for captives? I thought that 3 trends are worth noting. First, captives are poised to move beyond the predominant focus on single-parent captive models and the exclusive domain of large companies. In fact, many non-profit entities in the US and an increasing number of SMEs are accessing captive via group captive models that pool assets and share risk across its members. Parallel can be drawn from the mutual, which also shares similarities to takaful, or Islamic insurance. During the 1700s and 1800s, the earlier forms of captives were mutual insurers, formed together by firms from a particular industry that shared similar exposures. Today, mutual models are still very much alive. Their contribution to global premium has risen in recent years after years of decline, and they include captives set up as mutuals. The takaful industry is also thriving and poised to continue growing, in large part driven by growth in Asia. Overlapping markets of the mutual, captive, and takaful industries is likely to provide an important impetus for the wider use of group captives among mid-sized and smaller companies. This region is especially well-placed to harness this potential, given the vibrance of SMEs and fast-growing takaful market. Southeast Asia alone contributes almost 30% to global takaful contributions, and Malaysia has long sought to develop a facilitative regulatory environment to drive an innovative, competitive, and sustainable growth of Islamic finance. Second, technology will be a key driver and opportunity for new captive models. Technological advancements are already driving the growth of captive insurance business due to the new risks that business face. As industry founded in response to an inflexible insurance market, the history of captives is very much intertwined with innovation. The first captive can itself be seen as a disruption to the market. Captives can be expected to leverage on new technologies to modernize legacy processes and systems, strengthen risk management capabilities, and capture efficiency gain. At the frontier of development, the evolution of big data and insurtech has opened up significant new possibilities for segmenting and pooling risks and capital, and tailoring solutions to specific needs and profiles. Online platforms based on the group captive models and P2P insurance concept are a case in point. Given that captives aim to provide specialized coverage that is not typically available in the traditional market, it is only natural for captive to operate in this space. Third, we are likely to see greater traction in effort to understand captive from a regulatory and supervisory perspective. At a global level, there is greater appreciation of the role and importance of captive insurers, including the International Association of Insurance Supervisors. IAIS published 2 papers in 2006 and 2015, addressing the economic benefit of captive insurance and its relationship to traditional insurance and reinsurance markets. More significantly, it recognizes the importance of applying a supervisory regime that has due regard to the specific nature, scale, and complexities of various forms of captive. Ladies and gentlemen, a primary objective of regulation for captive is promoting financial stability. In this respect, regulators will continue to be concerned with risks that may be created as a result of arbitrage and distortion to the broader insurance market. Captives have an important contribution to offer. However, understanding risks relating to captives at a much deeper level will be important to deliver regulatory outcomes that are proportionate and economically efficient. Captive risks will differ from traditional insurance, no doubt about it. And they also vary significantly between different types of captives, depending on the ownership and structure, scope of business, and nature of risk insured. Managing this risk cannot simply be addressed at an institutional level alone. Macroprudential measures might have relevance in certain circumstances. For example, a pure captive insurer that merely underwrites the risk of its parent may pose low financial and consumer risk. But if the parent is an economically significant entity with critical financial linkages, a different regulatory response and approach might be warranted. To a large extent, our ability to design suitable regulatory framework for captives remain constrained by the paucity of data on captives. This needs to be addressed as a matter of priority. Broader measures need to be taken, both at national and global level, to collect data on captives, to understand the nature, evolution, and impact on macro-financial development. Increased effort by government to tackle profit shifting and tax-based erosion have been another factor behind current regulatory development. Significant changes have taken place affecting offshore financial centers in the past decade, shaped by heightened expectation for enhanced transparency and exchange of information between tax authorities. These winds of change are likely to pick up speed for captives, and they will change the way captives have operated in the past. Very likely, it would pave the way for transformation of offshore financial centers. Captives could transform from perceived brass plates models into legitimate commercial vehicles that serve a real economic purpose. Perception management is pivotal for the future existence of captives. Captives must be seen as supporting and contributing to the broader economic transformation and growth if it's to be taken seriously by the regulatory authorities. These three developments that I mentioned just now, the emergence of more diverse captive models serving a broader spectrum of companies, technological advancement, and more considered regulation, are likely to foster greater convergence between intended economic outcomes of captive and the required and appropriate regulatory framework. I hope that this forum will seize the window opportunity to bring together mutual interests that have long been somewhat at odds with the regulatory framework. As a collective, all of us here today have a common interest in ensuring that captives demonstrate genuine value and has valuable economic purpose. Achieving this call for strong corporate governance practices, greater transparency and sound financial management that commensurate with underwritten risk. Ultimately, a new reality needs to be embraced by captives. In the long term, investing in technology, technical expertise, better and stronger compliance framework are worthwhile endeavors. It's no more a choice for the captive industry. At stake is the viability of individual captives and an enduring captive industry that will add breadth and depth to the insurance market. Ladies and gentlemen, let me conclude. The captive industry may well be at a turning point. In moving forward, how we start matters. Effort to develop the captive industry should be focused on better risk management, promoting macroeconomic stability and encouraging new growth areas, rather than purely concentrated on tax planning. There are promising signs among business and regulatory sectors that there is a growing space for captives to play a role. It is important that we move forward to harness this potential responsibly and thoughtfully. Thank you very much. Assalamualaikum warahmatullahi wabarakatuh.